All right. All right, cool. We're recording already. All right. Hey, thanks for joining early, everyone. It's 11 o'clock Mountain Time. We're going to wait until maybe just a few minutes after to get started to give anyone who's still on their way a chance to jump in here. So maybe about 1:02, 1:03 Eastern Time, we'll get started here. Oh, looks like I have James Baccarini in the lobby here. I guess I'll let him in.
Should probably screen him off. Make sure he's on mute.
He's getting some insider tips.
He's muted. I think we'll probably go around 45, maybe 50 minutes today, depending on any questions that come in through the Q&A. It looks like Mike Mock is there. We have Debbie there, awesome. Bill here in Papa John. My mother's here, Regina. All right. Okay, so it's about 11:02 Mountain Time. So for everyone who's live on the call and for the recording later, we usually start with just a couple of updates from our office and any notices we might think you need to be aware of. So this will be our third monthly webinar we've done so far, and the plan is to do at least one every month. And right now, we're planning our next webinar is planned for January 10th at 1 o'clock Eastern, same time on a Friday. And the guest speaker is going to be Kelly Augsburger. She is our new long-term care specialist. Jeff and I finally decided that we do know a lot about long-term care, but those two things that maybe we don't know are the things that we'd rather put into the hands of a specialist. And Kelly's going to give us an education on long-term care and also a couple of practical ways you can plan for it, whether that be with earmarking certain assets or using different insurance programs that are available. There's a lot of options there to discuss with her. We will be closed the majority of next week and on New Year's Day, obviously. We'll do our best to get to any requests that come in for cash withdrawals, policy loans, that sort of stuff, but please expect a little bit slower stuff going on next week. Jeff and I are actually pretty sick right now at the moment too. Maybe you couldn't tell, but don't expect any big words from either of us today. Joseph Caldera is our newest staff support member. He joined us in early November. So if you see any emails from him in the future, he's a new member of our team. He's in Aurora, Colorado. He's working virtual support for us, and he is going to be helping with mostly for now insurance support. So if you have like a Lafayette Life Penn Mutual policy, and he's also helping us with general admin, so scheduling, confirming appointments, that sort of stuff. So if you see him or hear from him anytime in the future, he's definitely part of our team. So Joseph Caldera is the new member of our team.
And then also Alexis Kiefer is another one of our virtual assistants, more on the broker dealer side.
Alexis Kiefer, maybe a few of you have met her already, but she is assisting exclusively on the Cambridge side of our business. So think anything investments, IRA, or annuity related. She is our support staff for the investment related stuff. And she's been around about a year now. She's done great work, but maybe some of you haven't had a chance to meet her yet. All right, so you might notice that there's two faces you maybe haven't seen here before. This is Chris Cook and Dan Baccarini. They have graciously joined us out of their busy schedules to give us a little bit more of a in-depth review of Beacon Capital, who is an investment manager that we've partnered with for several years now. Jeff and I both use their strategy ourselves. We use it with our families. We believe in it very much. And you probably read from the emails, we keep saying that, yesterday's strategies don't really work in this new world today. And we still feel that way today. And that's why having a dynamic tactical approach to this new world is very important. And Jeff, anything else you want to say on that?
Just that, we have a lot of choices of who to work with through our broker dealer, who's, again, Beacon Capital's obviously been cleared through the broker dealer. And we really chose Beacon because, again, the tactical management. We want someone who's working 24/7 as best as possible so that when we have volatility like we just recently have seen, they'll do sells and buys, at the right time. So I personally saw 3 proxy notices that 3 positions that were in our equities have moved to bonds. And that gives me great peace of mind. So I kind of describe it as sleep well at night, SWAN for short, is what they represent for us. So yep.
It's something they don't really market about themselves, but they're very good at is service. We had a couple of clients yesterday notice that they're getting like 20,000 proxy notice emails all at the same time. And their team responded to us and had a resolution put in place like within the hour, if not within minutes. And I believe that individual has a form they can sign today to make those go away. So if you have gotten a lot of those emails lately and you're already a Beacon Capital client, just let us know if you want those to go away. We do have a solution for that. So without further ado, I'm going to kind of turn it over to you, Dan, if you want to kind of take it away on your presentation for us today.
Absolutely. First of all, I want to say thank you so much for everyone who's out there. Thanks, Matt. Thanks, Jeff. I really appreciate you guys and taking the time this afternoon as we're all heading towards the holiday. My name is Dan Baccarini. I'm the Managing Director of Beacon Capital. We also have on the line Chris Cook. Chris is the founder of Beacon Capital and the Chief Investment Officer of Beacon Capital. So he's the one that created everything we're going to see as far as the product-wise. But today we're really going to go into, we're going to start with not product stuff. We're going to start with just important stuff that everybody on this call are going to have some sort of interest in for sure. So what we're going to be talking about is answering your number one question, and I'm going to share our screen here. Let's get it all up. Just going to take me a sec, folks.
And I may interrupt you at times, Dan, just warning you ahead of time.
Absolutely, and I'm going to pull it up there. Please let me know if you're able to see the screen.
Yep.
Yep, you're
So
good.
And are you just seeing the presentation screen, not the other one?
Yep.
Yeah. Perfect. So today, again, we're going to be talking about solving your number one question. And everyone, when we always start with this, they always are like, well, what is my number one question? And we're talking about, obviously, as it relates to your financial plan. And I'm going to really stop, just real quick, I'm going to stop because I'm going to actually put my camera off while I'm talking. So it makes it a little bit easier for you to focus on the presentation. But please, Matt, if you have any questions, just, don't hesitate to ask away. So we're back into what is that number one question? And we're talking about your financial plan, your financial future, your retirement goals. What is the number one question? It is, am I going to be okay? Now, there's a lot of am I going to be okay out there? Am I going to be okay right now in these volatile markets? And this is a perfect example of it where the market's gone down, 4 or 5% in the past, 5 to 10 days. But there's other, am I going to be okays? Am I going to be okay in my retirement years? Am I going to have enough money to survive and to live at a good standard of living while I retire? Am I going to be okay if something were to happen to me, or if my heir is going to be okay, my family going to be okay if something happened to me unexpectedly? I know Matt had talked about insurance a second ago. That's one of those things, right? That is so important to all of us. Am I going to be okay if I became disabled? So there's a lot of am I going to be okay? And really, Matt and Jeff's job are to help you answer those questions. Really, at the very essence of what they're doing for you is helping you through the am I going to be okay scenarios during your financial journey. So today I'm going to talk about just 2 of those am I going to be okays. And the first is, am I going to be okay right now? And really we're talking about volatility. We're talking about bear markets. Bear markets are a reality that we must plan for. We cannot ignore them because bear markets happen more frequently than we think. They average about 1 every 6 years. And when a bear market strikes, the market goes down by almost 40%. most of us have experienced two bear markets in the past 4 years or so, right? We had the one that was during the pandemic, and then we had one in 2022. So bear markets are a reality, and they're starting to happen a little bit more frequently than we'd like, because negative volatility is ever increasing. All you're seeing on this chart is all the days that the S&P 500 has declined by more than 2% in a single day. So the market had to go down, or the S&P had to go down by 2% in a single day to show up on this chart. Now, here's the interesting thing. From 1950 to 1999, that happened 160 times. There was 160 days during that 50-year time period that the S&P went down by 2% or more in a single day. The last 24 years, that's happened 273 times. So 50 years, 160 times. The last 24 years, 273 times. We've decreased the time frame by half, but we've increased the number of occurrences by 50%. So negative volatility is ever increasing. And the problem is that this negative volatility, we have no idea when it's actually going to strike. This is something we refer to as sequence of return risk, meaning we don't know what the next sequence of returns are going to be in our portfolios. So here's a really interesting example. If we had $1 million and you were taking $50,000 a year and you increase it for inflation, if we experience the returns in reverse, in other words, 2023, 2022, 2021, 2020, etc., we end up with $2.4 million and we're okay. The sequence of returns is fine. However, that's not how we actually experienced the returns. We experienced them 2000, 2001, 2002, 2003. And if we experience the returns as they actually occurred, we run out of money in about 16 years. So sequence of return risk are one of those things that we have to deal with when it comes to, am I going to be okay right now? We have to plan for the bear markets, we have to plan for volatility, and we have to plan for sequence of return risk. Now, I'm going to show you an example. This was one example that shows you how impactful sequence of return risk is. But this next example is going to show you how small of a margin for error we have when it comes to sequence of return risk. We have 3 retirees in this example. Retiree number 1 retires in July of 1969, and their money lasts for their entire retirement. They're fine, great. The sequence of returns is okay. Retiree number 2 retires just 3 months earlier in April of 1969. They're still okay, but not as good as the one that retired in July. But look at retiree number 3 that retires only 3 months earlier than retiree number 2 and 3 months early or 6 months earlier than retiree number 1. They run out of money. Their retirement is not going to be okay. Sequence of return risk is a reality that we must plan for. We have to have something in our financial plan that deals with this issue. Now, what is the heart of all this bear markets, this volatility, the systematic risk, is something, or is the heart of it is called systematic risk. Systematic risk is the risk that's inherent in the entire market. You can't diversify yourself away from it. It's things like wars, recession, pandemics. These are all at the heart of systematic risk. And systematic risk looks like 2008. For those of you that lived through 2008, you'll remember that there was basically nowhere you could hide if you were in the stock market. Everything went down. The stock market itself went down about 40%, but all the different other asset classes, whether it's real estate or commodities or international, they all went down as well. This is systematic risk. 2020, March of 2020, when the pandemic, when the shutdown hit, everything went down. It didn't matter how diversified you were. When March of 2020 hit, you were going to get affected negatively in your portfolio. 2022, same thing, systematic risk. No matter how you invested, you were going to get hit. So we have to deal with these issues. So for Jeff and Matt to be able to answer the question, am I going to be okay right now? They've got to make sure they're planning, and you need to make sure that you're dealing with systematic risk, bear markets, and sequence of returns, and all of that volatility. Now, why this negativity is so bad, or why this negative volatility or systematic risk are so bad, is because of math. Losses have a greater mathematic impact on portfolio results than gains. Losses are more powerful than gains. If there's one thing I'd like you to take away today, it is this: losses are more powerful than gains. If you had a portfolio that went down 50%, you don't need 50% to get even. You need 100% to get even. People don't understand this. Most individuals don't understand this. Personally, I didn't understand this until I was taught it. Here's a little example that can actually illustrate this. It's called the tortoise and the hare. All we're going to simply do is take the hare portfolio, all the returns from the hare portfolio, and cut them in half for the tortoise portfolio. So if the hare portfolio is up 26%, the tortoise portfolio is only up 13%. On the flip side, if the hare portfolio is down 37%, the tortoise portfolio is only down 18.5%. At the end of the 10 years, the hare portfolio averages 1.2% a year. The tortoise portfolio averages 0.6% a year, half of the hare portfolio. But which one do you end up with more money in? You actually end up with, $10,000 more in the tortoise portfolio than the hare portfolio. Why? Because losses have a greater mathematic impact on portfolio results than gains do. See, we don't need to strive to get these up 26s as long as we avoid these down 37s. A lot of people take undue risk in their portfolios and their investments and their retirement plan by trying to get every little nugget of performance out of their portfolio. But when you do that, you're exposing yourself to all the downside. Again, we don't need the up 26s as long as we can avoid the down 37s. Now,
Dan, just for a second, we call that unnecessary risk.
That is, I'm actually going to steal that. so just so you know, you'll hear that in the next presentation. But that's exactly right. Taking that unnecessary risk because you don't need to. Just avoid that downside. Because remember, mathematically, the downside is more impactful than the upside. So you got to start putting math in your favor. Have it start working for you instead of against you. So the top, am I going to be okay concern? What is that number one concern that people have? It's this one. Will my retirement income last? There was a couple of articles recently. I'm just going to read you just the headlines. 66% of Americans are worried they'll run out of money in retirement. 57% of investors say retirement income planning is among the most important services offered by financial advisors, because this is really the crux of why you saved all your your life, during your entire working years, is to get to retirement and ensure that that money is going to last and you have a decent standard of living. There's one big problem you got to understand when it comes to retirement income. The math is different. Remember I showed you before, if you have a 50% loss, you need 100% to get even. Well, that's if you're not withdrawing any money. If you're withdrawing money for your retirement income, if you're withdrawing 4%, you now don't need 100% to get even. You need 150% to get even. The math is different during your retirement years. And it's really kind of obvious when you start thinking about it. If you are taking, in an example, 5% out of your retirement accounts, and the stock market goes up or your portfolio goes up by 10% next year, you didn't actually get a 10% gain. Because you were taking out 5%, you only actually received a 5% gain. And on the negative side, if the market goes down by 10% and you're taking out 5%, you didn't lose 10, you actually lost 15%. So the losses are magnified during your retirement years and the gains are weakened. That's why you can see the recovery math is so much greater during retirement years. So what's actually at the heart of your retirement years? What's the thing you should really be paying attention to? Now, the next several slides, to include this one, are a little bit technical, but I promise you, I will explain them and you will understand them. So let's start with this technical stuff. And again, I apologize, but you will understand it. And this is very important for you to understand. So we have two investment choices. Both of them have a little over 8% a year over the past 30 years. So they're pretty good investment choices. The only difference is investment one has a 9.82% standard deviation. I'm going to pause real quick. Standard deviation is simply a measurement of risk. It's a mathematical calculation, but it's a mathematical measurement of risk. That's all you need to know. It's very simple. It's a statistical term. So this standard deviation is used in science and math and statistics and economics and investments. All it is in this case is a measurement of risk. So investment one has a standard deviation, a measurement of risk, of a little under 10%. Investment two has a standard deviation, a measurement of risk, a little over 14%. So you could see it's a little bit more risky than investment one. But what's the impact? The impact is this. Investment one, we can afford to take out 3.9% a year, almost 4%, from your retirement accounts, and you'll have no problem with your retirement account lasting. Investment two has a 2.5% safe withdrawal rate. So you can see investment one, you can take out more money. Now, a lot of people are like, oh, it's only 1.4% difference. No, it's actually 56% more retirement income that you can take out of investment one versus investment two. Think about that. That's going from $2,000 a month of retirement income to $3,000 a month, or $4,000 a month to $6,000 a month. That's very impactful for your standard of living, for your retirement years. So this is a really important thing. A lot of people look at how much can I take out of my retirement accounts, and they look at the rate of return. And you can see that that really isn't the crux of the matter. The crux is how risky is this investment? Because both of them can get to the same destination, 8% a year over 30 years, but they get there in a different way. That's the important thing, is trying to actually figure out how can I get to the right destination, but I do it with less risk? Don't take the unnecessary risk. So I'm going to continue on with these a little bit of complex slides, a little bit technical, but again, you're going to understand them. You can see lots of squiggly lines, lots of colors. But let me tell you what this is. Every squiggly line here is just represents a 10-year period of the S&P 500. That's it. So every squiggly line represents a 10-year period of the S&P 500 going back into the 90s. Now, you can see the wide dispersion of returns. You can see it at the end of the chart here. That is a visual representation of standard deviation. See, standard deviation is simply this, that how much does something deviate from the average, right? The average would be somewhere in the middle of all these squiggly lines. And how far do they deviate from that average is what gets you the standard deviation. Now, this is showing you what the S&P 500 does. And you can see by that wide range of returns, it's very difficult for someone to plan into the future as to how much money am I going to actually be able to take during my retirement years. The reason is because we don't know. Are we going to be at the top of the range? Are we at the bottom of the range? Are we going to be in the middle of the range? We don't know. So let me just show you an example of one of the Beacon portfolios. It's the exact same chart, exact same time frames, exact same methodology. All we're simply doing is every one of those squiggly lines is a 10-year period for our Beacon portfolio, one of our Beacon portfolios, going back into the 90s. You can see that the dispersion of returns is much tighter. That's indicative of a lower standard deviation, a lower risk portfolio. Now I'm going to actually put them on top of each other. Beacon is the blue, the S&P 500 is the gray. Now I want you to take note once again of the standard deviation or the risk. Which one looks more risky? Which one has a higher standard deviation? Obviously, it's the gray, which is the S&P 500. So we have a lower standard deviation. And remember, lower volatility, lower standard deviation, lower risk is going to allow you to take more money during retirement years. Now, I also want to
Dan,
point.
can I interrupt you for just a moment?
Please.
So on that S&P 500 slide, just comparing that to the 2.0, what that really is saying is that, you know, the world over there at the S&P is very unpredictable. You know, you're either going to run out of money at 82 or you're going to have a $10 million legacy. I mean, it's a massive range of possible outcomes. And unfortunately, what I think what gets lost in the planning world is the advice that when you're in that traditional investment, you need to be ready to make changes and adjustments annually, maybe even quarterly, to manage that. And unfortunately, that's their only tool to fix that, really.
Yeah, that's a great point. That's really a great point. You could run out of money or have $10 million. It's the range of returns that you could actually, or range of possibilities that can occur. Yep. Another important thing with this slide, I think is really, really very important to understand. You can see that there's ranges of returns, there's 10-year periods that outperform a portfolio like us, and specifically us. And that's important to understand, because when you're in a lower volatility portfolio, you are going to have times that you underperform the S&P 500 or the market in general. But we bluntly will say we don't care. The reason is because we don't get this. And remember, losses are more powerful than gains. So if we can avoid this, we don't care about this, because the losses are more impactful than the gains. So that's a really important thing to understand, because you're going to be in a portfolio, if you're in a lower volatility portfolio like such as ours, there's going to be times the market's going to be up 38 and you're up 16 or something like this. You don't have to worry about that. You shouldn't even think about that at all, because there's going to be times that the stock market is going to be down 36 and you're not going to be. And that's the most impactful part. That's the more impactful part of your portfolio results, are those losses. If we can prevent that downside, we don't have to go for the risk, take all that unnecessary risk at the upside. See, Matt, I told you I'd keep stealing that unnecessary risk thing. I love it.
Yeah, hey, a second thing I wanted to say is, you know, when we're doing retirement income planning, you know, your first question, am I going to be okay? There's another question that we have to ask that unfortunately nobody has the answer to, is how long am I going to live? And on that bottom part of the chart going from left to right, I would presume that's age over time. You know, we could live to 105, we could live to 80, we could live to 90. I always joke that it's like gassing up a plane. We don't know the destination, but we know how much fuel's in there. We're going to make some changes with tailwinds, headwinds over time. But when we don't know our life expectancy, that makes the unpredictability of not having a defensive posture even more difficult to manage.
Yep. Yeah, that's a great point. Really good stuff. Now, most retirees don't use the S&P 500 solely as their investment vehicle. They normally use something called a balanced portfolio, which is like 60-40. So 60% in equities, 40% in bonds. So let's compare us with a 60-40 portfolio. Again, we're the blue, the 60-40 portfolio is the gray. You can see that by adding bonds to the stock portfolio, we did reduce the volatility, we did reduce the standard deviation. But you also notice that we really tamped down the performance. Now you've really shifted things downward. See, the challenge with simply putting fixed income into the mix always is that it does reduce volatility, but it also reduces performance. And there's times when we don't really need a lot of fixed income in our portfolio. If we're in a tremendous bull market, kind of like really what we were in most of this year until the past, week or two or a couple weeks, we didn't need a lot of fixed income in your portfolio, or any, because the market was really running up nicely. Every sector was doing great. It was just really running well. Past couple weeks, a little bit different. So we really want to use fixed income when we need it, not when we don't need it. Now, so what do we do? What does Beacon Capital do? First of all, we've been around since 2000. We have over 10,000 clients, over 14,000 plus accounts, maybe even more than that. So we've been around quite a while, and we believe in consistent return portfolios. We believe in lower volatility portfolios. All of our portfolios have a risk management overlay to really help prevent the catastrophic losses, help kind of, inoculate yourself, at least protect yourself against systematic risk and bear markets and sequence of return risk. But how do we do it? We have a 3-step solution. We want to maximize diversification, meaning we want to invest in the market. But we also want to minimize losses, right? We do know that bear markets are when events, not if events. They will happen. We just don't know when. So we want to minimize those losses. And then the third step is we want to maintain discipline, meaning we want to eliminate emotional decision-making, because we know emotional decision-making is what really causes a lot of problems for investors. So step 1 is participating correctly. We want to start by not using the S&P. So I'm going to just go on a little bit of a soapbox here to talk to you about the S&P 500. Chris and I did a webinar on the S&P 500 I think late summer, early fall, and we were talking about the structure of the S&P and the impact of the S&P and the risk of the S&P. The S&P 500, by most people, they believe it's the market, and I use that in quotation marks, but they don't understand what the S&P really is. So the S&P 500 is not a well-diversified portfolio like most people think. It's actually overweight in technology. In this example, this is actually showing through the end of last year, about 25% in technology. Right now, it's well over 30% in technology. So you're really in an overweight tech fund when you're in the S&P 500. And just so the structure of it is very weird. Most people don't think, they think it's like 500 stocks equally weighted. It's not that at all. The impact, well, let me just tell you this. Apple, one company, Apple is bigger than the entire real estate and energy sector. You could actually combine those two sometimes, and it's going to be, Apple is bigger than the entire real estate sector. All U.S. publicly traded real estate companies are smaller in the S&P 500, so the weighting. So Apple has a bigger weighting in the S&P 500 than the entire real estate sector or energy sector. It's absolutely crazy. So if you think about it, all the real estate companies, all the energy companies could go out of business, and Apple have some sort of great iPhone release today, and the S&P 500 would go up instead of go down, even though two gigantic sectors in the U.S. economy went completely under. Now, here's that impact. In 2023, we don't have the 2024 numbers, but in 2023, the 10 largest stocks in the S&P 500, their impact on performance was 97%. In other words, 10 stocks accounted for 97% of the performance of the S&P 500. So it's what we refer to as concentrated. As a matter of fact, it's so concentrated, it's beyond historical norms. I said 97%, the top 10 stocks, 97% impact last year on the S&P 500. Do you know what the historical norm is? It's 5%. Normally, the top 10 stocks impact the S&P 500 by 5%. Last year, it was 97%. The most recent high was in 2020 at 37%. So the S&P 500, if people are looking at that and go, wow, the S&P, look at the performance of the S&P 500. No, it's not the stock market. It's 10 companies. And almost all those companies are tech companies. I think they all are tech companies. So again, the S&P 500 isn't something that people should really be looking at as a comparative, or what we refer in our industry as a benchmark, because you're not really looking at a well-diversified portfolio. In fact, right now, we look at concentration, we measure it by how many stocks are outperforming the S&P 500. So what are the top ones? Right now, only 25% of stocks are outperforming the S&P 500, which is historically low. The average is 50%, right? That would make sense. Half the stocks are going to outperform, half the stocks are going to underperform, but not right now. It's historically concentrated. So the reason I bring that up is because so many people are doing two things wrong. I'm not saying you are, because I don't know any of your situations at all, but I'm just saying, generally speaking, a lot of investors are doing something wrong. Number one, they're using the S&P 500 as a comparative to what they're doing with their financial planner. That is, typically speaking, incorrect. If you're near retirement or in retirement, the S&P 500 has basically no relation, no comparison to what you're actually doing. your comparative, your benchmark, should be something that's based upon what your objectives are and the structure of your retirement plan, not the S&P 500. Because again, it's overweight, it's highly concentrated, and it's basically an overweight tech fund. The second most dangerous thing that people are doing is using the S&P 500 as their core investment vehicle. If you're in retirement, that's normally speaking a no-no. If you're near retirement, that's normally speaking a no-no. It's too volatile. It doesn't make sense for most people in or near retirement. The S&P 500, look, during the 2000s, it went down 50%, about 50%, twice in the decade. I don't know too many retirees, I don't know too many that are near retirement that can afford that kind of loss twice in a decade. And again, that's not theoretical, that's historical. That's exactly what happened. So if you are in that, or you know people that are in that, it's almost like a public service message for you to say, you need to talk to someone about this. This is not a good situation for most people. If you're in retirement or near retirement, for sure, that is extremely dangerous. You're putting a lot of stuff, a lot of future, a lot of retirement income planning at risk by being in an S&P 500 vehicle. That's S&P index funds, S&P ETFs, a lot of retirement plans, 401ks. The majority of assets in 401ks are in S&P 500 stuff. So if you rolled it over or you're in that, danger, danger, danger. Not a place to be. Definitely talk to someone about that. So I'm going to get off that soapbox. I'm going to kind of go back to our regularly scheduled program here. And so what do? We want to invest in the market. We know we need to be there, but we want to do it smartly. So we use 11 Vanguard sector ETFs, equally weighted. Sectors are just the little pieces of the economy, and it's the way we divide the economy. And it's things like healthcare, energy, financials, technology, real estate, etc. We divide them equally. And because we don't want to take a risk or an undue bet on a particular sector or not. So we use Vanguard. Vanguard's one of the largest, if not the largest investment manager in the world with trillions of dollars under management. They're very low cost, they're very well respected, just a good company to partner with. So we use 11 Vanguard sector ETFs. Why do we use sectors? Because they're little independent economic units that make sense and they're not correlated to each other. So what does correlation mean? What does diversification mean? Simply put, diversification is ensuring that your investment building blocks are doing different things at different times for different reasons. We can measure that difference mathematically. It's called correlation. So these numbers that you're seeing are the correlations between all the various sectors and the S&P 500. A 1 is a perfect correlation. So you can see industrials has a 0.92, which basically means it's 92% correlated to the S&P. And as we go down the various sectors, you can see they're less and less diversified. Now, the traditional asset class investing, so that's like someone going into a growth fund or a value fund or international fund, we think of those as diversified because they have different names. This is another one of those little important facts. Because something has a different name doesn't mean that it's diversified. It just has a different name. Because you can see that mathematically, those things are pretty close. They're 92% correlated. So you're not very diversified. Whereas in sectors, you're much more diversified. And the reason is because sectors are like little independent economic units. Some work great when the economy is expanding. Some work great when the economy is contracting. This is what you're wanting. Your building blocks, your investment building blocks, doing different things at different times for different reasons. Now, why do we equally weight it? Remember I said 11 sectors equally weighted? Well, it's because of risk. And remember, We want to try to find little areas that we can de-risk the portfolio. And this is our first line of defense in that battle. Now, this chart is showing every sector ranked from best to worst every year going back into 2008. You'll notice something here. Look at how these sectors change all the time. They're going all over the place. So like, I'm just going to use utilities as an example because you can see that they're red, so it stands out on everyone's screen. If we were looking here and we said, Mr. Client, let's not invest in utilities. Look, it's been the worst or second worst performing sector 2 years in a row, 2009 and 2010. Oh, look, next year, it's the number one sector. So Mr. Client, let's invest all in utilities. Oh, nope, now it's the bottom again. See, this is, remember we talked about that tortoise and hare portfolio? That is the hare mentality. We want to get into tortoise mentality. The white is equal weighting. Look what happens with equal weighting. You're never going to be at the top, but you're also never going to be at the bottom. And remember, the bottom is more impactful mathematically than the top. We don't care about being at the top as long as we're not at the bottom.
So, Dan, look at how perfectly cyclical everything is. I mean, when energy's on the bottom, it's almost inevitably on top the following year. Yeah. Same with utilities and consumer discretionary, and that's why I sometimes tell people, if you're picking what to invest in this year, don't chase what worked last year because last year was different. It was a different circumstance, different economy, different everything. So,
yeah, you're exactly right. I mean, it's crazy. I mean, utilities and financials and material healthcare, even what you wouldn't think, but it's on the top and then it's in the bottom. It really is. It's definitely it's a fool's game trying to chase performance like that. I mean, you just got to figure out, okay, what's going to make sense. And again, we don't want to chase it. That's where people get in trouble, is they start trying to chase these top returns, and inevitably what happens is they hit one of these down years. And that's more impactful than trying to chase all those up years. So a lot of people on this call, quite possibly, because I just know, just investors in general, are, from what we've already said, they agree with, and they're doing some sort of asset allocation. Most people have an asset allocation portfolio. If you're working with a financial advisor, I'm sure you have an asset allocation portfolio. But there's a problem with a lot of asset allocation portfolios. They're not taking into account this: bear markets, systematic risk, volatility, and sequence of returns. See, asset allocation works well until it doesn't. So you have to move on to step 2, which is avoiding the catastrophic losses. So at Beacon Capital, our portfolios employ 2 different risk management overlays. The first is what we refer to as our 2.0 portfolio. All we're simply doing with our 2.0 portfolio is taking those 11 Vanguard sector ETFs and overlaying it with a 10% trailing stop loss. It's trailing. So as the market's going up, we're locking in those gains. That's it. If it closes down by 10% or more from the most recent high, we're going to sell out and move into fixed income. This is what it looks like. This is normal allocation. This is the fixed income allocation. This is risk off. And then we go back to the normal allocation when it says risk on. Why do we use 10%? It's because of math and history. The math is we want to avoid the catastrophic losses, so it's easier to get back to even. Remember, if you're down 10%, you only need 11% to get even. It's only a 10% increase. If we are down 50%, we need a 100% increase. That's a 100% increase. So over the loss. So math is important. The other thing is history. What we know is that over the years, if the market goes down by 10%, 44% of the time, almost half, it goes down by 20% or more. 1 out of 4 times, it goes down by 40% or more. So we want to make sure that if we say go out, we're going out to avoid the catastrophic loss. Is it going to be right all the time? No, it's not going to be right all the time. There's nothing that's right all the time. If you hear that's right all the time, you should probably turn around and go the other way, because it doesn't exist. How to get back in? It's based on two things: time and rebound. I'm not going to spend a lot of time here because it's a little bit technical. Basically, understand this, that we're going to go back in when the market is showing mathematically that it's in a real recovery. And it looked like this in 2020. We would have gotten out of the market, so everyone remembers the pandemic. We'd have gotten out at the beginning of March 1st. And that's what kind of that blue line represents. But you can see the market continued to plummet down and down and down and down. Eventually, mathematically, the market was telling us we're in a real rebound. And we then got back into the market April 1st, and we were up 20% net of fees or whatever it was in 2020 in the 2.0 portfolio. Now we have another risk management overlay called 3.0. 2.0, that I just explained, is all in, all out. That's the stop loss. 3.0 is looking at every single sector for strengths and weaknesses. So if healthcare shows a weakness, we're going to sell that sector. If technology shows a weakness, we're going to sell that sector. And we're looking at it based on math and history. So we're not making a guess, we're using math and history to tell us. And we'll leave all those other sectors in. Now we can't use 10%, so we create this risk management overlay that basically generates a bear trend line at the bottom of this channel and a bull trend line at the top. If it breaks below the bear, we sell. Breaks above the bull, we buy. Again, it's not based on guesses and guts. It's based on basically math and history. Now,
so these are kind of like pre-written rules, Dan. Like Chris isn't waking up in the morning and saying, "Hey, I'm feeling good about energy today," and just throwing that in there. Yeah,
all pre-written rules. Everything's known in advance. We don't change the rules once we're in. So it's very, very important to understand that. And that's really going to get us to the third leg of the stool in a second. But in this chart, I don't really want to go into this chart much, but what it's showing at the bottom of the chart is that 2.0 is all in, all out. Very simple. 3.0 is going to dial out each sector at a time. So you can see that chart at the bottom is basically showing what sectors we're in at any given time. So it dials in. It's a little bit more agile than 2.0, but they're both designed for different markets. So that's what's kind of nice, that if you blend the two, you kind of get the best of both worlds. Now I'm going to go right to maintain discipline. This is the part that gets investors in trouble. It's the part that gets me in trouble. It's the part that gets a lot of people in trouble. It's that emotions create roller coasters, right? When the market's going up, I want to put everything in. I don't care. Risk doesn't matter. When the market's tanking, I'm scared. I don't want to be in it anymore, and all that. Let me show you an example of reality. During the 80s, the S&P went up 16.2% a year. There was a star manager named Peter Lynch, the Fidelity Magellan Fund. He was up 21.8% a year. But look at this. The average investor during that time only got 13.4%. How is that? It's kind of emotions. See, if you would have stayed invested the entire time, you'd have gotten 21.8%. But clients, because they're not on a mechanical approach, like Beacon, like what Matt referenced, we're rules-based, you know exactly what's going to happen. You're able to stay the course versus freaking out and moving and going everywhere else. That's very, very important. I'm going to close with this example for you to understand, am I going to be okay? And really the implication and the margin for error. If you had a 65-year-old with $1 million in an 80-20 portfolio withdrawing 5% a year, again, they're retirement years. If you retired in 1975, the money lasts for 30 years. Am I going to be okay? Yes. The answer is yes. If you retire 1 year earlier, 1974, the money runs out in 13 years. A single year. See, am I going to be okay going from yes to no is a very small margin of error. See, 1974 performance of the S&P was 26%. It was a bear market, systematic risk, single year. See, the a lot of people don't understand the consequences of not dealing with bear markets, systematic risk, volatility, the math. They're ignoring it. I think a lot of people have financial plans that they're just hoping that they're going to be okay, but they don't have actual preparation to deal with systematic risk, sequence return risk, volatility, the math of losses. They don't have that. They're just ignoring it, just hoping it doesn't happen at the wrong time. So I'm going to pause myself and get back into the actual deal here. I'm going to stop sharing. I'm going to turn on my camera.
Awesome.
Fantastic. So Matt, do you have any questions? Otherwise, I'm going to turn it over to Chris. Well, first of all, Chris, do you have any comments or anything from what I just went over?
Yeah, no, it was great information, Dan, as always. Just a few quick points, I think, just to highlight the most important spots. One, everybody should take away that losses are more important than gains. They really do have a disproportionate effect on a portfolio over time. So, and that's really important when you are close to retirement or retired. And I don't think a lot of people kind of think about it like this, but that's the point. When you retire, your net worth is probably the highest it's ever been in your life, right? So there's a lot of dollars at stake on that particular day. So right there, you have to change your mindset and shift. When you were 30 years younger, and you're investing your money in your 401k or even into a pension, the market went down. It wasn't a big a deal, right? You lost 20%. The dollars didn't add up to that much money. But if you take that same 20% loss today on your net worth or the value of your retirement accounts, that's a lot of money, and just put it in perspective in terms of how much maybe you make in terms of a salary, each year. I think you'll be really surprised and almost terrified, to be honest with you. I know I look at it like that and think, that really hurts. Now I got to work. It's like 2 years of my life work, right? And that's before taxes. So, I'd really take that to heart. The other thing that is important is a point that Matt made, is that all of our strategies and portfolios are rules based, and whether you end up using Beacon or not, it is something I would suggest. When we're talking about our life savings, we tend to be very emotional. We just can't help it. And I often think back, Dan, you and I had this conversation. Remember back when COVID was kind of at its height, and we were out of the market, so we were safe, right? And then early April comes along, and I think you showed the chart where we bought back in. We had a conversation. It was relatively late at night. I don't know. It's probably 10 o'clock at night or something here on the East Coast. And I remember saying, this is a really bad idea. I don't want to buy back into the market right now, just because, the world was still kind of on fire. We didn't know what was happening. This was a pandemic. All of the models that I had built, they were built on financial models and math. I mean, I didn't know how to deal with a, international health crisis, but it was the absolute right thing to do. The probabilities told us that it's in our favor to buy back in now, and you kind of go with it. And the downside to probabilities are sometimes you're wrong, but they're right most of the time. So you lean into it, and if you're right more than you're wrong over the course of your investment career, then you're doing pretty well, and retirement will be okay.
Yeah, I remember that moment, April 2020.
Yeah,
we were buying back in, and I was like, "Is this the right time?"
But
sure enough, it was right.
In my career anyway, over the last 30 years, that's that's been the most extreme example for me
Mhm.
of emotions really, kind of getting in. And even, Warren Buffett has often said, those investors that make the most money are investing hard when everybody else is running away, right? It's kind of like the fireman or the police officer, right? They're the ones running towards the fire. They're running towards the gunshots. That takes a certain mentality that most of us just don't have. And a rules-based strategy really, really helps if you know what you're going to do before you actually have to do it.
I remember those days very clearly. The end of that first month, it was March 30th, I believe. Our most aggressive clients who are all in the market were all out of the market, 100%. And I looked at that and it's like, holy mackerel, that's what it's all about. We were in a shared office at that time with other registered reps, other investment advisors, and it's like they had their hair on fire, running back and forth. And both Matt and I were just calm because we knew that these models were in place and they were doing what they're supposed to do. So awesome.
Awesome. So this is going to be recorded. So everyone who's here right now, you'll get a link probably the next 30 minutes or so to send that out. And Chris, I'll even pump your book for a second. It's called Slash Your Retirement Risk, right?
Yes, it is. Thank you.
Okay, cool.
My background right there, Matt.
So, so that's on Amazon. I believe it's a hardback cover. And if you want to learn more from a technical standpoint, I think that book is a pretty good place to start. But you can also ask Jeff and I. So we work with this every day. So.
Great. Well, thanks, Dan. Thanks, Chris. Amazing talk, and we really appreciate all that you do, and our clients appreciate it as well. So,
we appreciate you guys. Thanks so much. Appreciate it, Matt. Thanks, Jeff. Thanks for the invite.
Yep. Thanks,
Dan.
Dan.
Great holidays.
Happy holidays, everyone.
Happy holidays. Merry Christmas. Bye-bye.
Bye-bye.
Thanks, guys.